good afternoon, good morning, predominantly for those of you in the US and the Americas. Thank you for joining our webinar today, the Transition Plan Guidebook, Engaging to Win, where we will discuss the notion of a, quote, one-size-fits-all silver bullet transition assessment methodology using the oil and gas sector as a case study. My name is Piotr, and I'm part of the events and communications team here at Carbon Tracker. The intended runtime for this webinar is about 45 minutes, depending on the number of questions, with 60 minutes of a hard stop. Mike, our head of oil and gas, will go through the key points in the report before we move to answering your questions. If you'd like to ask a question, then please do so via the Q&A function. Please don't send the questions anonymously. And if we are unable to answer it live or it requires a follow-up, the team will, of course, be in touch afterwards. And a replay will be sent after the webinar, as well as links to the downloads of the slides. Now, Carbon Tracker is a not-for-profit financial think tank. Our vision is a fully decarbonised global economy well before 2050. All our research converts climate science into financial risk and reward with the aim to accelerate the energy transition by mobilizing the financial markets. And of course, all our work, including these reports, is free to download on our website. And I'd particularly like to draw your attention to our YouTube and our explainer videos on the bottom right, which is a new initiative that we started. And you can find a sort of synopsis of the report by Mike on there as well.
Great, thanks very much, Piotr. Today I'm going to give a really high-level overview of the recent note we put out, Oil and Gas Transition Plans, a User Guide. And in this, we're looking at what corporate transition plans are and what they're not, and what are some of the differences between them. How can investors assess them, and how can we navigate some of the myriad of different frameworks, reporting standards, focus on data, disclosure that are currently being discussed? Why oil and gas is perhaps a bit different to some of the other sectors, and why a decarbonisation approach is potentially not the most effective. And then some key sector-specific metrics for assessments that can, of course, form the basis for engagement, both around climate impact, but also transition risk and opportunity. And then we'll have an extended period of question and answer that will involve myself and Adam, moderated by May. And so, as Hannah says, our reports are all freely available and downloadable for free from our website. So without further ado, we'll get straight into a brief sort of 12 to 15-minute presentation before moving to the Q&A. So first, corporates are publishing transition plans, and they come in a whole range of different forms. So, for example, I've just picked out 4 examples here. You've got Exxon's Advancing Climate Solutions Plan. You've got Chevron's Advancing Energy Progress. You've got Shell's Energy Transition Strategy. And you've got Total's Sustainability and Climate Progress Report. Now, how do you get decision useful information for these, whether you're a climate concerned investor or a mainstream investor purely focused on financial risk and opportunity? Now, a lot of these plans are ultimately conflating a number of different things. They're conflating reduction in emissions. They're conflating investment in the new technologies needed to accelerate the transition and the new or the evolving energy system, perhaps better referred to as the low carbon energy system. But of course, also discussing reducing financial risk. And really, these things are quite separate. And obviously, there's a number of different reasons why these are combined in the same document. But ultimately, what we're trying to do here is distill these reports down to what are the key to the key information investors need and some of the key metrics they can use to assess these plans and ultimately engage with corporates to assess transitions. And of course, there are a lot of frameworks out there as well. And I've just highlighted some examples here. There are a lot of different framework setters, guidance documents, and assessment providers. And if you look on the left of this slide, this is an example taken from Total Energy's Sustainability and Climate Progress Report, where you have a number of different organizations that have rated them. And you have a whole range of different scores, risk numbers. And the question is, are these decisions useful? And is the underlying data and assessment methodology actually supporting investors and other financial market participants in assessing corporate transitions and actually assessing the transition that they wish to see place? And again, many of these conflate a number of different things: reducing climate impact, investment in low carbon energy systems, reducing transition related risk exposure, and also action on operational emissions, which is relevant for some sectors, but less relevant to others. And of course, all of this is against the background of transition plans or corporate transition plans being increasingly mandated by policymakers and regulators. Examples in the UK include the Transition Plan Task Force, and obviously in the European Union, there's EFRAG, which is supporting European sustainability reporting. And these are sort of welcome steps forward, but it's critical that such regulation is there to protect society, both from reducing systemic risk related to climate change, but also the risk of market failure. And such guidance and frameworks, it must not be captured by incumbent narratives and actually must be there to serve wider society and investors and others in assessing these companies. So how do we navigate some of this complexity? Well, first, frankly, it's absolutely imperative that as an investor or other stakeholder, you're clear on what you are trying to assess. Are you trying to assess the response to climate-related financial risks and opportunities, or are you trying to assess the reduction in climate impact of corporate activities? And of course, what you're looking to assess will be driven by your investment mandate, whether that is an explicit mandate to take climate impact into account, depending on so Article 8 or 9 funds, or it's a more and it's obviously linked through an implicit mandate, both from a fund labeling, say it's a sustainable fund or a green fund, or from corporate positioning as an investor positioning on climate. For example, membership of, for example, the Net Zero Asset Managers Association, or if you are an asset owner who's a member of the Net Zero Asset Owners Alliance. Now, is that a positioning on climate, or you have a clear mandate from your beneficiaries? And of course, there's a universal owner perspective for long-term institutional investors who are invested across the market who will seek to reduce systemic risk. And we'll perhaps come onto that in some of the discussion. But in effect, there are two types of corporate transition plan. There is the climate-related risk reduction plan, which is not to that ESG reporting. It's about disclosure material financial information. And then on the right, there is a climate impact reduction plan, aka sustainability plan. So investment in renewables may be an opportunity, but it doesn't reduce the climate impact. So it's critical we do not conflate these two. So actually, for many sectors, a strategy of decarbonisation actually supports both reduction in climate-related risk and reduction in climate impact. So, for example, if you're a demand sector, it's ultimately about trying to make widgets, but using fewer emissions in the process, whether that's your scope 1 and 2 emissions in the production or the scope 3 emissions of the suppliers you use, the suppliers you use. Crucially, those are upstream in the value chain. So by you switching suppliers, you can reduce your emissions. Ultimately, you can decarbonize the product by reducing the emissions associated with its manufacture. But for oil and gas and other supply sectors, there's much different ultimately. And as the companies repeatedly say, they don't have direct control over the scope 3 emissions that are downstream of them in the process, because those are the customers' emissions. I think the clear argument there is that oil and gas companies sell a product that is inherently reliant on the release of emissions. And with scope 3 emissions, 85% of full life cycle emissions, clearly that is those end user emissions are a key problem. So as I say, for oil, a strategy of decarbonisation supports both transitions for many sectors, but for supply sectors, that's not necessarily the case. Crucially, action to reduce climate emission impacts poses an existential threat to fossil fuel suppliers. It's not about supplying the same thing with fewer emissions. Ultimately, it's about the energy system transitioning to something fundamentally different. So away from a fossil fuel-based system to a low-carbon energy system. And so if we just think about, what I'm showing here is thinking about climate-related risks split into 3 broad categories. And this links through to the TCFD, so the Task Force for Climate-Related Financial Disclosures classification. And so I've split those into 3 main buckets: physical risks, transition risks that are related to regulatory and policy action, but also reputational risks, and then transition risks that are more technology related, consumer preference, ultimately changes in demand. And of course, the relative impact of these sectors will be felt will be felt differently among different sectors. So very illustratively, I've put 5 core sectors on there. And you can see, for example, agriculture, clearly that sector is predominantly impacted by the physical risks related to climate change. So changing weather, changing water, changing temperature, etc. From a sort of manufacturing, using our widgets example, you have the transition risk will be more predominantly related to policy and regulatory change, i.e. reducing emissions associated with that manufacture. Then I've also put three other sectors: power and automotive and oil and gas. So the power sector in some ways is impacted a little bit by all three. You think of the physical impacts of impacts on transmission lines in California and wildfires. You think of the automotive sector, it's about reducing emissions associated with mobility, but it's also about shifting the powertrain and the shift towards electric vehicles. So there's a combination of regulatory action and also technological change. But for oil and gas, the reality is the impact of climate change on the business model is fundamentally a change in demand for the product. And we'll see that policy action on the physical risks to prevent physical risk materializing and causing issues to agriculture and many other systems will drive transition risks that are regulatory and policy related for many demand sectors, in this case, manufacturing, so as shown by the red arrow. And of course, those changes in demand sectors pose a technology related demand substitution risk on the supply sector, so oil and gas. And this is why decarbonizing oil and gas doesn't really work as a concept. You can decarbonize the demand sectors, but you can't really decarbonize oil and gas. Ultimately, the transition and averting kind of the worst impacts of climate change requires us to move away from using oil and gas. And of course, that's not to say that Scope 3 emissions don't matter, but by talking emissions, sometimes actually that plays into a kind of incumbent narratives, as with the conversation then moves talking about carbon capture and storage, nature-based solutions, negative emissions technologies, offsets, etc. Actually, we need to take it back a step. For supply sectors, it's fundamentally about changing business models. And that's true whether you're assessing transition risk or climate impact. And so oil and gas needs to plan for falling demand. And some of you may have seen this diagram I've put up previously, taken from Navigating Peak Demand, but really outlining the options for the upstream portions of these businesses, so the oil and gas production. And so these producers have to do two things. First, decide what to do with the upstream businesses from a spectrum of accelerated decline and exit through to continuing business as usual replacement or even growth. And we've illustratively put a few of the companies through there. Second, what these companies do, having decided the upstream strategy, is to decide what to do with the capital that's reinvested. And of course, there's two broad options. One, return this to shareholders, whether that's through buybacks or dividends, or two, invest into new businesses. But crucially, this is about the transition away from being an oil and gas company, and it's not essential for oil and gas companies to transition to anything, whether from a risk perspective or from a climate impact perspective. And it's critical that frameworks and assessment methodologies do not assume, whether implicitly or otherwise, that companies must transition to something. From both perspectives, it's about transitioning away. And so for an oil and gas company, the notion of a transition plan in itself is actually a bit odd. It's effectively either an energy transition response plan to the demand substitution risks, which may include diversification, or it may not. Or it's a climate impact reduction plan. And so having sort of laid that out, having sort of really become really granular on, or really clear, on what you're trying to achieve, what type of transition you're looking to assess from companies, ultimately related to investment mandates. The second thing is to focus on some really key critical sector specific metrics. As we've outlined, focus on decarbonizing and looking at Scope 1, 2, and 3 emissions intensity over all energy, and metrics like that are fundamentally kind of missing the point from either perspective. So focus on key sector specific metrics. From an energy transition response plan, so assessment ultimately of risk and opportunity. We see these are four key metrics. And of course, and I'll show you how these key metrics are also relevant for looking at climate impact reduction. First, CapEx plans. Are new projects financially viable as the transition unfolds? Are new developments, particularly exploration, is that potentially value additive to shareholders given the unfolding energy transition and likely weakening commodity prices as demand weakens through the 2030s? Looking at oil and gas CapEx versus distributions and diversification spend. Again, it's not oil and gas CapEx versus new CapEx necessarily, because that would implicitly assume companies must transition to something. We're looking at absolute levels of oil and gas CapEx, and we're looking at the relative level of oil and gas CapEx versus distributions or diversification. Looking at production plans, what is the duration of companies' production? So over what time frame is companies' production exposed to changes in commodity price? Executive remuneration. Are executives incentivized on growth, particularly in fossil fuel production growth, or in value creation, which is then ultimately strategy agnostic? And you can create value either through a diversification either through a diversification strategy or a harvest strategy. And then the fourth of our key metrics we see is looking at emissions targets, but crucially, it's about the framing of those targets and how those are delivered. Those emissions targets, if they're framed appropriately, link through to Scope 3 absolute emissions reductions. Actually, what those are a proxy for future production plans and development plans, and thus those can be used to support those top two items in the table. Critical also is looking at the cost of achieving reductions. We talked earlier about how some companies are seeking to reduce the Scope 3 emissions related to their activities, not by reducing production volume, but by seeking to act on emissions through CCS and other offsets and nature-based solutions. The question is, at what cost, and at what cost to the consumer? And from a risk perspective, how does that make these fossil fuel-derived products even less competitive versus lower carbon products, or low carbon products, I should say? And finally, action on methane and reduction in regulatory risk exposure. Now, these same metrics can be used to assess climate impact reduction, but potentially assessed against different scenarios, for example. So looking at CapEx plans is critical to assess the reduction in corporate climate impact by asking, are new projects compatible with Paris goals? And are companies planning for production declines? Clearly, as the world to achieve Paris goals, overall oil and gas demand and consumption must fall significantly over the coming decade, and with a huge decline out to 2050. And we cover both in our Paris-aligned report, a series of reports looking at CapEx plans production. From executive remuneration, when looking at the climate impact perspective, it's slightly different. You're looking at, are executives incentivized to develop new resources, i.e. are they incentivized to continue to do the things which are contrary to reducing climate impact? It's a slightly different nuance to looking at the energy transition response, but ultimately you're still looking at that same core metrics, those same core metrics in the same core area around executive remuneration. And then emissions targets framing, are those targets linked through to finite limits? Again, are they framed appropriately? What is the credibility of those plans? Are plans simply achieved just by selling assets, or are they achieved to create space for new developments, or are they actually achieved by a commitment to not invest into new projects, manage existing projects, including action on methane, and ultimately adopt a sort of harvest mode for the upstream portion of the business, irrespective of what that company does next? And there are other things to consider too, potentially more relevant to one of these two assessments. Sensitivity to the pace of transition, and we're at the moment developing work around net present value sensitivity under different paces of transition. Operational emissions performance, particularly from the perspective, and methane's a key component of the perspective exposure to regulatory and policy change, particularly, for example, around things like CBAM. The timing of decommissioning obligations, asset retirement obligations, new business areas, and whether a company has a competitive advantage or not. There is no reason for companies to diversify into any specific areas, although there may be some diversification opportunities for these companies. Obviously, the level of dividends and buybacks. And then from a climate perspective, we also see lobbying is being crucial. And we detail those more in the note, as we do with all of these different metrics within the transition plan user guide framework. And so it's critical in our view that these core metrics, these core sector specific metrics, form the basis of frameworks and guidance documents related to assessing oil and gas companies in the energy transition. It's crucial then those plans do not necessarily incentivize transition to anything. It's about transition away from a legacy business model. And so to conclude with some summary messages, ultimately, just to reiterate, as a stakeholder, it's absolutely clear, you need to be absolutely crystal clear what type of transition you want from corporates. And the oil and gas sector is different. Decarbonizing is potentially missing the point about from a risk perspective around technology-related changes in demand, which may themselves and are likely to have been precipitated by policy action on climate. So these technology-related changes are absolutely climate-related risks. Corporate plans must be far better at distinguishing between discussion about climate impacts and climate risks and opportunity, and should not be framing investment into renewables as somehow offsetting or negating the climate impact from their legacy businesses, which continue to form the vast majority of investments and revenue. Sector-specific metrics are critical. And then finally, frameworks and guidance documents, as we just said, must be crystal clear on the types of transitions they support for the protection, ultimately, of consumers and financial markets more broadly. So thank you for listening to that very brief overview. Please do read the notes and please do reach out to us if you'd like to discuss further. So Maeve, perhaps I'll pass to you now if we move into Q&A.
Great, thank you, Mike. A couple of reminders before we launch into the Q&A. If you have not done so, please drop your question into the Q&A box, and please don't do it anonymously, because if we don't get a chance to, or if we don't get around to your question during the webinar, we will follow up with you over email bilaterally. On the screen, Mike, perhaps if you just go back to the previous slide, you'll see a QR code via which you can download the report, the user guide that Mike has just discussed, and so please do follow that. And lastly, just as a reminder, joining us for the Q&A is Adam Gillett, who is a Senior Investment Manager and Climate Lead at Railpen. So we've had a couple of questions coming in already, many based off the content of the presentation. So Mike, perhaps I'll kick off with, you described in the presentation that oil and gas as a sector is different from others. Why would you say that is?
Yeah, so I think as I tried to sort of touch on a high level, oil and gas ultimately is supplying something. And so a framework of, and a lot of the frameworks out there around transition plans were developed, and for good reason, developed predominantly around demand sectors. So looking at how do you decarbonize consumption, it sort of ultimately stems from a focus on efficiency. So how do I drive same number of miles but with fewer emissions? How do I create this widget with fewer emissions? And as I say, a consumption sector has control over its suppliers, and it has control whether that's energy suppliers or the suppliers of individual components and the embedded emissions all the way up through the value chain. For a supply sector like oil and gas, those emissions result downstream. And so in some ways they can't do much about them. Yes, they can change some customers to some extent, but ultimately it's inherent. These emissions are inherently within the product. And the policy action on climate to reduce emissions, the emissions from the product they sell, that policy action is changing consumption patterns, and that has a knock-on effect. As I tried to illustrate with that triangle. Ultimately, to avert climate change, the energy system must transition fast. To avert the worst impacts of climate change, the energy transition must occur quickly, and that proposes that demand substitution technology-related transition risk for the oil and gas companies.
And within the presentations, we mentioned some of the other kind of guidance and assessment frameworks that are out there that I'm sure many members of our audience are using. But what would be kind of some of the issues that you see with some of those frameworks that are out there?
Yeah, I mean, let me highlight two key ones. One, quite a lot of them are focused around disclosure, and disclosure is all very well, but that should be a prerequisite for any plan being potentially considered credible. What matters is what is the actual plan of what is the company planning to do and act across those key metrics. I think others are focused on just more data, more disclosure. Well, actually, no, it's about looking at sector-specific metrics. And if you were to just look at those four things I highlighted there, perhaps a couple of additional other ones too, as we highlight in the note for those two separate assessments, you would form a very clear view on companies, either from a transition risk exposure and opportunity perspective or from climate impact. So less is more in this context, but it's crucial to be sector specific. The second one is that some metrics inherently require companies to transition to something. The reality is we'll still be driving around in mobility. We'll still need widgets, but we don't need oil and gas in 30 years' time. Yes, there'll be a residual amount, but ultimately need some fundamentally new way of providing energy. So, and assessments of companies, so looking at scope 1 and 2 emissions per joule of energy provided, well, that implicitly assumes companies must transition to become renewable energy providers. This is not necessarily in the interests of the climate, and it's certainly not necessarily in the interests of investors either.
And we have a question around, since you just mentioned emissions, but so a lot of these, or a lot of what we hear out there is around addressing emissions, particularly Scope 3 emissions. So why do you think there should be kind of less of a focus, or why are you not so focused on Scope 3 emissions?
Yeah, I mean, I want to be really clear. Scope 3 emissions matters and is to some extent useful. Don't take it this way, but I think there's in some frameworks are overly focused on that they then, particularly when assessing companies from a financial risk perspective and the energy transition risk exposure perspective, that they miss our companies, that they miss the fact that companies are still focused heavily or predominantly on producing a product of which there's going to be weakening demand. And we even saw it there in the first example I showed of looking at Exxon's strategy. I mean, it's all about reducing Scope 1 and 2 operated emissions intensity out to 2050. Well, that completely fails to acknowledge, either from a client perspective or from the transition risk exposure perspective, the fact that there's policy action to reduce consumption of these things, and that will weaken demand for their product. So by talking about emissions, in some ways it allows the companies to obfuscate and the legacy narratives and incumbent narratives to become entrenched. And actually taking it back to production volume, are companies still planning for investing in new projects? Is the production that results going to be value additive given credible future commodity price forecasts as the transition unfolds? And that, particularly from a risk perspective, is fundamental.
If I could just add in there, and I kind of divided my view on risk from an investor perspective into two kind of broad camps, one of which is looking at some of the individual holdings within our own portfolio. And so that could apply from a fund management, any other investment perspective. And when I'm trying to understand the risks and opportunities in those individual names and at a portfolio level, I agree the emissions there really don't tell me very much about the risks that I'm exposed to and I'm trying to manage, or the opportunities that are available to there. And so the concentration and focus on data gathering and frameworks and emissions focused engagement within individual companies, I think is missing some of the bigger ticket items that Mike explained so well. But you've got this duality in emissions, because the other big chunk of risk that I care about, particularly because I represent a very long-term, well-diversified global investor, is systemic risk. And, climate is a huge systemic risk to us and a real threat to us achieving our organizational mission to kind of pay benefits and pensions and secure our members' futures. And their emissions really do matter. So real world emissions really, really do matter. They're, what's going to drive just how much worse the climate crisis is going to get, together with some other societal and climatic tipping points. And so I think this emissions complication has these two elements. And what I try to practice myself, but certainly encourage others, is when looking at individual names and individual risk analysis within a portfolio, to move beyond or past or round emissions, but really focus within the back of the mind in those discussions, but at the front of the mind in, say, policy and regulatory discussions, that real world emissions do matter an awful lot. It's just the translation of individual company actions on emissions into those real world isn't necessarily the straight path that sometimes it's set out to be.
Yeah, I think that's a really interesting and good way of putting it at the end of the day. We have a question from Frederick, which I think picks up nicely on kind of chatting about the incumbents. And he asks, what is your view on the existing transition plans of the sector and actual performance/delivery?
Well, I'll make some initial comments and then pass to Adam on this one. Well, I mean, clearly the frameworks, and from a kind of regulatory perspective, they are being firmed up. Things like FRAG and TPT have only been around a couple of years, and some of that guidance has only come in fairly recently, and obviously companies have time to implement it. But if you look at the current range of different transition plans, and as I touched on, they are called all sorts of different things, undoubtedly deliberately, and Exxon's advancing climate solutions. And I think what's happening there, if we've got a company all of saying, well, look, we'll solve this. We can solve our emissions. We can address them, which again, I think this totally illustrates my previous point, rather than actually focusing on the fundamental of the weakening demand. And I think there is a risk piece there of so much focus on CCS, particularly CCUS, so enhanced oil recovery, nature-based solutions, and other things. They're talking about the emissions, whether those things really materialize and really deliver the real world emissions reductions they're actually purported to deliver. and what is the cost associated with that. And if it becomes too costly, the reality is the new projects may have been developed with the emissions reductions just simply don't happen because they're too costly, and ultimately that is then overall additive to the global stock emissions. So sort of the question about how do our companies delivering on their transition plans. I think there would be that aspect on the emissions, but I think there's the other point, and I touched on if you look at the Europeans seeking a strategy of pivoting to become energy companies, and of course some of them have sort of retrenched a little bit from that over the last 2 years. The reality is a transition plan framed around becoming an energy company and reducing the emissions intensity of your energy, is not applicable to all sectors. And even the companies that have ostensibly said they're going to do it, they have kind of come back ultimately, and in part because of investor sentiment, and investors, particularly the North American investment community, does not necessarily buy in from a financial perspective to see that transition happening. So again, I come back to the transition again should be away from a legacy business model rather than being prescriptive about what companies go and do next. To date, I don't think the transition plans, the self-set plans, have actually are very well set, and I don't think they've actually been delivered either.
My view would be similar, that it's a very mixed bag out there. I think you talk well, Mike, about the way in which lots of elements are conflated, deliberately or not, into these plans, and that makes them very hard to navigate from an investor perspective and quite hard to engage around as well. And then ultimately, for many people, trying hard to assess and hard to grade and rank and so forth. So I think that's like the heart of the challenge for investors and for companies as well, because I do think that there's a big challenge on their side that it's fair to acknowledge. When I think about the ultimate performance and delivery against them, then I think there are some really good operators out there who are making operational enhancements and kind of delivering on those elements. But yes, missing out a lot of the time on the elephant in the room. And if I look at the kind of end indicators, to me, the amount of transition risk that I'm carrying in my portfolio at the moment, that is not going in the right direction and hasn't been for the last few years. And the amount of systemic risk that I'm exposed to and the organization is exposed to is, again, only increasing at a really frightening pace and against a very urgent timeline. So for me, when I'm thinking about the successful delivery and execution of plans, I'm thinking back to those risk measures that I really care about, both within my portfolio and at that systemic level. And the verdict on both of those at the moment is not good. And so that's, I think, why ultimately so many people are so concerned about this and trying to throw in all of the different solutions and the angles to unpick this puzzle. And I think that when we do that, to avoid it becoming an even more mixed bag, then it needs to kind of have this kind of laser focus on the things that really do matter. And to pick out a few from the report, which I really recommend, this notion of transitioning to something versus transitioning away from feels like such a small semantics, but it's just such a kind of light bulb moment and junction. So I think it's really, really important for investors to have real clarity on that when they're assessing and engaging around these plans.
Yeah, Adam, I think you touched on some really good points there. Thank you very much. I mean, I think I would just recap of these plans are enormous. I mean, they're 30, 40, 50-page documents. The reality is they need to focus on a few of those key metrics. And TPT, the Transition Plan Task Force guidance is clear. You should be looking at both climate-related risks and opportunities, and also disclosing about reducing climate impact. But you can take a lot of the fat out of these documents and just focus back in on a few of the fundamental metrics, and more data and greater precision of data, greater precision on the wrong or an irrelevant metric is not additive at all. You can trim these things down to focus on those key elements, and absolutely encourage all with engagements with corporates from either perspective to focus on those fundamental metrics. And I think something I didn't bring out was, that can then bring ultimately the stewardship teams and the mainstream and the portfolio managers together to ask for those same core metrics that can support assessments from either perspective.
Right. Yeah, I think that point around the transitioning to / away from and the distinction is one that gets lost a bit, and we've certainly had several questions about it. So Mikhail asks, isn't it key for or isn't oil and gas companies' investment in renewables key if they're going to transition from oil and gas production, and what alternatives do they have? And similarly, Pavel asks, if they are to diversify, what would be the kind of logical industries and activities for them to move on to, and where might they have value add?
Yeah, I think to the first question, I think the key point for me is they could invest in renewables, and it's not just the renewables generation; it could be the whole system. Electricity. For example, BP is investing heavily in BP Pulse and EV charging, and that could be a very, is likely or potentially a good diversification opportunity, leveraging its network of retail distribution forecourts. So it's not that they shouldn't do it, but they shouldn't be obliged to do it, and things should neither mandate nor implicitly assume in the framework. So you have a framework of you're scoring somebody on their transition, whether or not they invest into renewables should not in fact impact an assessment of their climate reduction in their climate impact, or an assessment of their reducing transition risk exposure. It may be an opportunity, but there are plenty of others. So it could be that the subsurface skills and the project engineering is of benefit to the hardest to abate and hardest to substitute sectors in providing CCS services in a limited capacity. Trying to CCS all the emissions from all transport fuels, like some of the US companies are doing, is just frankly ridiculous in terms of the cost involved, let alone some of the technology challenges. So, and there are other areas. So it could be that there are some limited role for biofuels and other things, but none of these diversification sectors are anything like the scale of existing oil and gas production and fuels provision. So it's likely that and integrated companies maybe have more options, as I say, the BP example, than the independent, so the exploration production only companies that maybe don't have a downstream, they don't have refining, and they don't have retail distribution. So again, it's horses for courses. We should not be mandating that a small oil and gas producer becomes a renewables company. They don't necessarily have any skill. So it's of no benefit, not particular benefit to the climate, and is certainly not in shareholders' interests, particularly seeking to pivot a company from one business model, basically an income business model, to an early stage growth one. So with difference in volatility as well. So strategies should absolutely be agnostic. Sorry, that's quite a long answer. Adam, I don't know if you're passing to you quickly.
Well, I think investors tend to put out that we're not there to dictate company strategy, and I don't think that this is a special case exception that would change that. But what investors are really good at, both stewardship professionals, climate experts, but portfolio managers, equity analysts, and everyone else, is kind of understanding where there's value creation, really testing and interrogating future value creation. That's what we want to see as shareholders. We want to see our shareholder money invested effectively and so forth, and not misspent or poorly spent or poorly invested on things that aren't going to give good returns. So I think when it gets to your diagram in peak oil, where you've got the range of options, and then underneath, the question is, what do you do with that capital that you would have traditionally known exactly the clear pathway to do, given that shouldn't be as much as an option as it was historically. And we're absolutely open to the idea that money returns to shareholders. The oil and gas industry will have to be, if we're to avoid worst climate breakdown, a much smaller sector in the future than it is now, and same back to history. And other sectors will be much bigger. But we're quite used to, as investors, this cycle of industries going up and down, creative destruction. There isn't one company that's existed through time that's done absolutely everything and moved with all the trends and been able to pivot and have the kind of applicable, transferable skills. So I think that what is really important to take away is, as you say, Mike, the implicit or explicit assumption that a company will be exactly as it is size-wise or growth-wise in the future. That's just clearly a nonsense assumption if we look at any company through history. But to think dispassionately about what is the best way to spend the capital, the cash, and to plan for and to react to a transitioning future that we desperately need to undertake. So I think that step again feels to me, back to the transition to or transition away, a very clear fork in the road that we shouldn't kind of drift down the path kind of unconsciously because of an implicit assumption of the way things have been before, but kind of say, actually, we've got a very real choice to make. And it's an absolutely aligned decision for all kinds of investors and portfolio managers to make about what is the best way for our shareholder capital to be invested. And if it's not within this company, then send it right back to us. That's no problem at all.
Great, cool. And if we move away from the question of diversification to another kind of important topic, Joe raises the question, if policy is the main driver in altering demand, should the focus of assessment and engagement for oil and gas companies be on their lobbying activity? And what is a reasonable expectation in terms of lobbying? Adam, I think you'd be a great one to come in here.
I mean, I love the question and love the theme, and I think it's one that more and more people are paying more and more attention to, and so it's absolutely right. So I think of every room that I'm in discussing this kind of stuff, and regulation, and we need more regulation and policy is the answer, and therefore it's incumbent on us to use all of our different leverage points to do that policy engagement and advocacy and push for the right kind of policy environments to set up a successful transition. So that can be from our investor perspective, us doing our own policy advocacy to our regulators and our industries and so forth. But I think one of the most powerful investor channels is exactly engaging with corporates on their underlying lobbying activities, policy engagement and advocacy efforts, both the ones that they do directly themselves, but also indirectly through their industry associations, which are hugely, hugely powerful and have been for decades in this. And ultimately what you want to see, or what I want to see as an investor, is this train of logic through a company's strategy, sort of setting out that forward path. What is it going to do? Is it going to diversify into these kind of stuffs? How is it going to make its decisions and so forth? The policy environment that it needs and could enable that activity best, and how it's advocating for that. And so the alignment through that, and then being that developed into CapEx plans and through remuneration and so forth, but being lobbying and advocacy being an integral part of that strategy and how it's delivered. And what you absolutely want to avoid is the kind of notion that you've got this straight line of logic flowing through, but kind of the lobbying and advocacy being a misaligned element, pulling it off track or working counter to those goals. So within our engagements, I can speak personally with companies in this area, it's a massive thematic priority we pay attention to in all our critical climate engagements and kind of more broadly across the piece. One of the things we're looking for is a starting point of lobbying alignment disclosure reviews. So to set out your views and your stance on climate risks and transitions, to set out your direct lobbying and how you carry that out and assess the alignment of it with those stated strategy goals. And then to look through your indirect lobbying activities through your industry associations, to look at the lobbying that they do on your behalf, whether that's aligned to your own strategy and goals and beliefs and aims, or where there are elements of misalignment, what you do about that, how you act and how you escalate on that. The ultimate framework we've got in that is there's a framework for responsible climate lobbying, and that's assessed also for climate action 100 plus companies via Influence Map. And they do like the most fantastic work digging into this and kind of pulling out these disconnections and these misalignments between stated positions, transition goals and lobbying activities. So hopefully that's given a decent starter on the topic. It's obviously one that I'm very, very passionate about and think is hugely important. And so would just encourage everyone, wherever they've got a touch point on advocacy and lobbying, whether that's directly themselves or indirectly, to pay real attention to it, because I think it's one of the most powerful tools that we've got to kind of correct course on this topic. Yeah.
Excuse me, absolutely. I think we've heard investors say quite frequently that they're using lobbying as a lever. So you spoke there about teasing out kind of your investee companies' views on climate, and Maria raises the interesting question around many of the audience may have seen that ExxonMobil came out with an energy outlook Monday this week, which forecasted global oil demand in 2050 to be the same or even slightly higher. So the question she poses is, how does that kind of messaging affect the fundamental assumption or the credibility of plans put out thus far? And furthermore, how does this affect asset managers' engagement efforts around net zeros when companies have such kind of, or are putting forward, ideas of such bullish future oil demand? Mike, do you want to kick off?
Yeah, sure. I mean, I think the first thing I'd say on this is, incumbent companies are clearly going to put out forecasts that suit their aims, and that is natural and unexpected behavior. I think what's critical is actually diving into that. Is it realistic? Looking at other forecasts of the future, independent forecasts of potential commodity prices, and then factoring in how the transition is changing. 4 years ago, China's new vehicles in China was a very low percentage of EVs. As of last month, they're in about 50% of new vehicles are now electric vehicles of some description. That the change is happening, and it's happening really quickly. And so, as an investor, ultimately, you need to say, is this a credible forecast of the future? But crucially, this is why also you need to look at the sensitivity of companies' plans. They're saying, okay, this is a forecast. Okay, that's great. But companies should be then providing, okay, well, actually, what is the impact to the net asset value and the NPV of their underlying project under a faster than expected transition? So this is where investors, frankly, need to get comfortable in asking for and dealing with multiple scenarios or multiple forecasts. And looking at that sensitivity analysis, because actually, if a company's portfolio is resilient to different paces of transition, that is far better situation than if you have a lot of really long cycle, really long duration exposed to commodity price out into the 2040s and beyond production. So if you're doing new exploration, so again, what are the investment plans? Is it long cycle, deep water, expensive exploration and long-term developments, or actually the company's more insulated from that? So, and I think then from the second part, and I'm sure Adam will add some comments on this, but from a net zero, well, at a really high level, net zero, Exxon's plan, presumably its plan is based around its forecast of the demand, and therefore its plan is demonstrably not aligned with the goals of the Paris Agreement. So you can look at any of its emissions reporting or look at its scope 1 and 2 intensity and all the rest of it. But this is why we just bring it back to those sector-specific metrics. If its forecast is of very high oil demand and it's continuing to invest, then it's demonstrably not aligned. And therefore, if you have a climate mandate or you're a net zero asset manager, it's clear that you should not be investing in that company and be seeking to unwind positions both from an equity and a debt perspective. That would be my point. Adam?
Yeah, I think that investors' natural terrain is looking into the future, looking at a range of scenarios, kind of looking at probability weighting them and seeing where there's risk and return and where that kind of makes sense for your underlying investment mandate and portfolio construction. So the notion of scenario analysis is really, really useful, I think, as a tool. And I think particularly in some markets where there's some quite good mandated financial statement assumptions and scenario analysis, they can lead to really, really productive conversations with companies where you've got a disclosed set of assumptions and pathways, and therefore you can really interrogate it and challenge around it and think where their plans and their targets sit within those. Often they're preparing, for example, their financial statements not on the kind of same basis as the assumptions as their plans and their objectives, and you've got this disconnect that's revealed through scenario analysis that is really, really valuable and can lead to meaningful engagements rather than some circular debates around who's responsible for the scope 3 and the rest of it. I would say the fact that Exxon put out the numbers that they did, I don't think is very surprising, but you've got lots of other different alternatives and BP's famous forecasts and so forth, and the IEA scenarios and lots of others to compare and contrast. And it's an absolutely valid question to pose to companies why they've got conviction in theirs versus others, but also if they're wrong, how wrong could they be, and what, as Mike says, exactly the sensitivity to those different scenarios, because that gets back to the fundamental point of the transition risk that people are exposed to in this. A variety of future scenarios could play out, and we need to navigate that on a risk-reward basis from an investor, and to engage them actively to manage down the risks where it's sensible and to position themselves in a way that makes sense for them and for us. So I think it's a really ripe area for discussion. I'm glad that people put out those numbers. I'd particularly advocate for looking in markets, obviously in places like Europe and other, where there's some quite mandated elements and quite well disclosed elements in financial statements. If you kind of read the details, and you can pick up and have a really, really valuable engagement discussion with companies around those different scenarios, sensitivities, commodities, assumptions, and their CapEx plans. So I think it's a really, really good question and point to highlight. So thank you for whoever popped that in.
Right, and I'm conscious that we are approaching the hour, but maybe just one last question, because we've spoken a lot about the listed companies, but of course, the largest proportion of the world's oil reserves are in the hands of national oil companies. So I would be curious here, especially from Adam, on how best one can engage with NOCs. And then as well, so this question comes in from Timothy, I should say, and is there another way to approach transition planning for them? Or maybe another way of asking would be what metrics, Mike, that you have called out would be particularly relevant for the NOCs? Adam, would you like to kick off?
Yeah, so I must feign that I don't do personally directly. I haven't had a lot of direct engagement with NOCs myself. I think there's obviously a policy route which is really important, and wider routes into those kind of national policy settings, which will obviously flow through those organisations. So I might kind of I don't want to overstate any credibility in terms of an answer on that one, but I do completely recognise the point that they're a huge part of what we have within the system, and therefore a huge contributor principally for us to our systemic risk. I guess for me, what I try and do as an investor, and so my justification for not spending too much time directly owning, engaging with these people, is I've got to play what I've got in front of me and pull the levers that I think are most effective in terms of what I have ahead of me. I do think there's a huge kind of policy element to that, but also to the extent that they're very kind of influential and important, there's maybe some creative thinking that I need to do about how best to get them, or better to get them through this agenda. But yeah, Mike, you might have a more coherent answer.
Yes. So I think the NOCs face these same transition-related risks. I think we are absolutely seeing a consolidation and an increased market share of the national oil companies and organisations like OPEC more broadly, and that ultimately reflects that the listed companies have been a bit more restrained over the last few years than historic, and we'd expect that to continue. Ultimately, these national oil companies have a resource they want to monetize, and they don't necessarily need to get the same returns out of it that equity investors would expect in the listed market or even in a private market. So you'd expect to see that. Definitely expect to see that trend continue. But of course, they still face the same risks, and action in global action. Oil's a global market, and similar things apply for gas, albeit a little bit more regionalized. From an oil perspective, weakening demand, and whether that's in China as electric vehicles roll out, or in Europe as they do, or in time as that same happens in the US, that will expose the oil and gas exporting nations to these same related transition risks. And again, it's driven by that technology related risk. We've explored this in our petrostate series. So most recently, petrostates of decline. We look at the fiscal vulnerability of different oil and gas exporting nations, so very much linked through to the NOCs. So you'd expect to see, from an equity perspective, now only some of these companies are just some of the companies are listed, and they're then generally in quite low proportions. But even for the fully state-owned companies, debt investors have a clear role to play here as well. And if you are a bank and you have net zero commitments, again, why are you still providing loans to companies that are and finance, whether at a project or at a corporate level, to companies that are demonstrably not aligned with climate goals and reducing their climate impact? So both from a risk perspective and particularly from a debt perspective, I think is NOCs. That is one way to engage them. But again, continuing to engage around the demand sectors with policy action demand, we'll see accelerate the transition and changes in consumer behavior, which will create this transition risk. So that continued pressure on demand sectors will create that transition risk, and ultimately the NOCs will have to reduce their oil and gas production over time, perhaps not as fast as the listed companies, and the oil and gas exporting nations need to diversify economies to ensure fiscal sustainability.
Great. Well, I think that's all we have time for, more or less. So I will wrap up by saying that the Transition Plan User Guide, like all of our reports, is available for free to download for free on our website, as well as the other reports. I might just mention petrostates, as well as navigating peak demand, which was presented in Mike's presentation. I'd also encourage you to take a look at our company profiles. So we released those at the beginning of this year, and there is a profile for each of the 25 largest oil and gas companies, including several NOCs. And those profiles contain many of the metrics that Mike will have discussed today, as well as some metrics, and they also incorporate lobbying, and we draw on data from Influence Map, as well as kind of summaries of analysis from the rest of our reports. A replay of this webinar will be available on YouTube in the next kind of day or two, so please do circulate to anyone who you think might be interested but wasn't able to make it today. And was delighted to see that we were inundated with questions, so much so that we certainly didn't get a chance to answer them all today. But we will reach out. Thankfully, you all left your names with your questions, so we will be in touch to follow up on questions we didn't unfortunately get to answer today. And that leaves me to say, coming up, we have a couple of reports from the oil and gas team, so you can look out for reports on LNG, on methane, on the NPV sensitivity of oil and gas companies, and further down the line we'll have a report coming out on petrochemicals and the viability of a pivot to petrochemicals. So again, all picking up themes of the discussion today, and we very much look forward to seeing you all again soon, and thank you very much for joining.